Folks, sorry, sound check. Can you hear me? I very much apologize for my tardiness. A little bit of technical error, and then I had a phone call come through. Oh, okay. Let's do this. So what we have here is a hell of a day. And what we're going to be talking about tonight are the monthly charts and the weekly charts to determine how we are looking to close out this week. And on some of the charts, we're going to take a look at how we closed out the month of February and how we're doing thus far in March. It gives us an early glimpse as to what sectors, i.e. energy, which has been strong, transportation, which have been strong, have they put in monthly highs? Might they be the first to find a bottom and rebound? That's what we're going to talk about tonight. We're also going to talk about bonds. You know, we've been getting together here on Sunday nights and Thursday nights for a long time now, and we've been talking about the bond market, the yield curve, and I know that people's eyes gloss over that. It's not sexy to talk about, but it's a threat. It's a big threat to our positions, and frankly, it's why I haven't been aggressively trading of late. It's because I've been focusing so heavily on the bond market and building short positions, and we started hedging our long positions back in November. We remain long, but we booked profits, and then we slowly but surely became mostly now net short. We still have a couple of long positions, few long positions, gold miners, silver, gold, and one ag play. So we are fairly sizably short. We're looking to add more. I think we're going to get an opportunity to add more, and we're going to talk more about the strategy for doing that tonight. We're also going to talk about the Fed meeting today. Not a Fed meeting, the interview. I caught a piece of it. I caught the rest of it on YouTube a short while ago. And I got to tell you, I was not impressed at all. And obviously, neither was the market. The narrative is breaking down. Fed Chair Powell, all the respect due to him, it's a tough job. But he's reading off of notes. He's not good at impromptu conversation because he knows that one slip of a tongue and the markets go ripping higher or ripping lower, one or the other. But he doesn't have the confidence to deviate from his prepared script and what was whispered to occur, which was a quasi-operation twist, buying longer dated maturities and selling shorter dated to manipulate the yield curve. That wasn't done. That wasn't delivered. So if you're wondering why the market sold off, that's why. There wasn't more heroin injected. And that's what this market needs. The problem where we're at right now in this market is not so much that we're still buying $120 billion worth of securities, meaning the Federal Reserve every single month. It's not enough that we have 1.9 trillion in new spending. It's not enough that we didn't even spend 1 trillion from the last stimulus package. It's not enough. You have the law of diminishing returns that are hammering the economy now. They need to keep printing more and more, dramatically more. They're going to have to take out a bazooka to keep this party going. And at some point in time, confidence gets eroded. And I think that's what you're seeing right here, right now. So before we get into it, folks, tonight's sponsor is going to be our folks and friends over at TrendSpider. Don't settle for ordinary trading software, folks. Get the value and power of automated technical analysis. Automate your grunt work, speed up your analysis, improve your accuracy, reduce costly analytical mistakes, and find winning chart setups, and time those trades with precision by using alerts. You're going to see how I use the algorithm, the automated technical analysis tonight, and the alerts. If you are worried about, wow, this is too much for me, don't worry about it. They don't leave you hanging. TrendSpider University, they have more tutorials here than I could shake a stick at. And those guys, Dan, Jake, and their team, they will walk you hand in hand. They have webinars. They will teach you how to use this product. 35% discount code below. Take advantage of it. Lowest price on the web. Let's get to it. All right. So the market today, again, they went into the day. As a matter of fact, I didn't even read this. I just saw the headline. I pulled it up. No hints at a twist. All right, so what that is this. What they want to do is manipulate the bond market. They want to change this. This is your yield curve. So right now, the yield curve is ripping. Short duration bonds are yielding appropriate yield versus longer dated maturities. They're not inverted like back here. They're properly priced and they're moving up higher. The problem is overlaid here in blue, the S&P 500 can only withstand so much of that because of all of our debt. And eventually yields get too high and the stock market rolls over. You saw it back here in 2000, steepening of the yield curve. Over we went. Back here, 2007, 2008, steepening of the yield curve. Over we went. Fast forward, here we're at. It's beginning to come. Chickens are coming home to roost. So this is the problem for the market. It's the problem for the Fed. And in short, why are yields going up higher? A couple of reasons. One, the economy is beginning to open up. It's getting better. The other part is that the Federal Reserve has printed about a quarter of all dollars in existence right now were printed in the past 12 months. Think about it. That doesn't mean much when the economy is closed because nobody's spending. They're trading stocks, which in and of itself is a bubble. You have inflation in the stock market, right? So that ballooned a bubble. The problem is now is that you're going to have buying. You're going to have people traveling again. But there's not many planes to go flying around. What happens to prices? They go up. So you have lower availability of goods and services, yet a lot of dollars that have been printed chasing them, and there's a lot more being printed. So that's going to cause inflation, and the bond market knows it. They're telling the Federal Reserve, they're telling everyone, listen, here's the 10-year yield. Listen, you guys are out of your mind. We know inflation's coming down the pike. We want to get paid more for our debt that we're lending you. That is what you're seeing right here, right now. And the market has been telling you that for months. Every Thursday, every Sunday we get together here, we look at this chart. And we've been saying, watch out. Once we break up and through this red line here, it's not going to end well. And sure enough, we are finding ourselves in the beginning of a serious correction. So yield curve at the highs last seen at, we closed, wow, man, this is messed up. The highs last seen since November of 2015 on the yield curve. Crazy. 10-year yields. First, I didn't say hello to everybody. My technical issues and phone call threw me completely off game. Sheena, Franklin, Macario, Franklin, long time no see. Ricardo, what a day. What a freak. Now that's a shirt. That's a shirt, man. Joseph, Pat, hey, brother. How's that Irish soda bread? NY Jets, great call in the market. Thank you very much. McCarter, again. Big Bear, hello, sir. Paul. Franken again. I'm making sure I get you. 480 shenanigans. Hey, brother. Langley McGannis, haven't seen you in a while. Great to have you here. Nestor. Falcon. Hey, brother. All right. Trisha. Wow, the lovely Trisha. I haven't seen you in a while. How you doing? R-Train. Dan. All right. All right, let's do this. Okay, so bonds. The cost of borrowing is going up. Inflation is going up. The pressure on the consumer is going to get tighter and tighter. So remember last week we hit 1.56 on the 10-year Treasury, and the market buckled right here. Today, we hit a high of, this is not accurate. We were higher than this. Stockcharts.com is saying 1.54. That's inaccurate. 1.557. 1.557 is the most recent high on the 10-year yield. So we are on the cusp of putting in a new weekly high on the 10-year yield. Forget the tips. The US dollar. Now, here's the other problem for gold mining stocks. Gold mining stocks actually behaved pretty darn good today, I have to say. We're going to go to that in a moment because we have a game plan worked out. We're going to buy more. I think that we're nearing a bottom on the GDXJ and UGT, the gold mining stocks. The problem for them is that the US dollar has broken out on the week. One trading day left to go. We don't know if it's going to be successful, but I'll tell you, it looks like it's going to break out. But again, one trading day left to go. A lot can happen here. But if we do successfully break out, what does that mean for commodities? It means that you're going to get pressure on gold, silver, copper, ag. So that may depress ag prices for a while. But the question is who's going to want to keep buying US dollars? Because we keep printing more and more of them. So I think that any rally in the dollar is going to be short-lived. Once you get bonds in the US dollar rolling over together, that's when things get real fast in this country. Okay. So dollar breaking out. Let's take a look at it on a monthly time frame. Not bad. 3 sequential months up on the US dollar. I think it's personally a dead cat bounce. But as it stands right now, we have a new monthly high on the US dollar. That in and of itself is bullish. So if you're wondering, why am I looking at a monthly chart when it's only the 4th of March? That's why. I want to know, did we put in a new monthly high? Because that means we overcame any resistance from last month. So the trend is still higher. So beware the US dollar here. Dollar's looking pretty good. Short term anyway. The VIX. Now the VIX has put in a new weekly high and we have backed off. But this is a fairly bullish setup. Stokes hooking up nicely. Let's drill down to a daily chart. No breakout yet. What was our high on the day? 31.90. Let's take a quick peek at a monthly chart. All right, so this is a very tight wedge formation forming here on the VIX. And I want you to take note of the stochastics. All right, so you have a little bit of a triangle formation forming here. Take note of these Stokes. We broke out back here in April, May, March, we broke out. And we pulled back, and while the stock market has been making all-time record highs month after month after month, the VIX won't go down. It won't go down. And Stokes have been doing nothing but consolidating, putting in higher lows, despite the fact S&P 500 making all-time highs. This is a problem. This is the market sending you a signal that there is underlying strength. There are people buying VIX options to hedge. And it's not people, it's institutions buying VIX options. They're going to remain long the market. They may be selling now, but they remain long of the market, but they had an insurance policy covering their hedge. So they were hedged on this ride up. And it looks as though we're getting ready to pump up higher. Dow Transports, new all-time highs this week. And now we are negative on the week. I pointed out a couple of weeks ago we had a bearish divergence going on RSI. Same deal here on Ultimate Oscillator. Stokes, weak. They're rolling over. MACD had already gone negative. Now we have what appears to be a bull trap. The appearance of going positive only to fail to go negative. Dow Jones weekly chart. We bounced well off the lows of the session today. Monthly chart. We are holding a breakout here on the Dow. If we fail to hold, let's call it 29.5, and we fail to hold this support level, look out below. That's a breakout point failure or a bull trap. S&P 500. Weekly chart, bananas, not good. Volume is not horrible. Not horrible at all. Let's take a look at a monthly chart, then we'll drill down to a weekly chart. No new monthly high. Look at the Ultimate Oscillator, just taking a nosedive. While we've been putting in higher highs, look at this negative divergence. Same deal here on RSI. You know, if we ignore these signals by the market, we do so at our own peril. You know, you look at these, you can't short simply because you're seeing a divergence, but you should reevaluate your position sizing, tighten up your stops, and look to get to the short side, maybe throw on a couple of hedges because all is not well. So, daily chart. Now, here's where the rubber meets the road. And this is what I've been talking about with members for several days now, is that we've really refrained from adding more to our short positions because we haven't had a break in the market. We had a double top, maybe, but if we don't break down to lower lows, all we have is a consolidation. So you don't go shorting into a consolidation. You go shorting into a break. So what I wanted to add more to our short of the triple Qs yesterday because they broke support. They put in a lower high and broke to a new lower low yesterday. The only reason why I didn't is because I was concerned about the whispers coming out about Jay Powell coming out with Operation Twist. That kept me at bay. I was worried about a rally. And this morning I would have been right. But then that rally faded. So what we're seeing now in the S&P 500 is we have lower highs and we have now broken to a new lower low. The path of least resistance effective today has now changed, at least in the short term. Daily chart, short term, has now changed to the downside. So what may look like a bargain right here, right now, may be a trap. So beware the morning rallies. They're going to try to rally this market and try to give the appearance. They're going to put lipstick on a pig. And they're going to say, okay, yeah, look, upgrades. There's going to be, on next Monday, there's probably going to be a share buyback announcement out of Apple. There'll probably be several upgrades, the likes of which, the number of which we've never seen in decades, some sort of hype to get the amateur money off the bench because the whales out there need the plankton to feed off of. And that's how they view us. We're plankton. And the whales need us to get excited, go in there buying stocks. That way they can unload. So don't get lured in. So beware. Today's lows may be tomorrow's highs. Think about it. Now here's where things get interesting. The IWM, the small caps, of which we are short using a leveraged ETF, they have now confirmed their breakdown, and at least on a daily time frame. We tried to rally this week. We were rejected. Volume, well above average. We have institutional distribution. MACD, this is about as long as in the tooth as it gets. And when you drill down, actually, I don't want to drill down to a daily chart yet. We'll go to that. I want to bring you to the reason of why we've been so tenacious with our short position of the IWM. And I want to go to the monthly chart. This chart here, most of you will be familiar with this. This is my area Bollinger Band using the 3 standard and the 2 standard deviation Bollinger Band. And you can see that we're about as far extended from this 48 period moving average that we've ever been in history. Nosebleed levels, never been there before. This chart takes you back the entire span of the lifetime of the Russell 2000 IWM tracking ETF. We have never, ever, ever been this far extended. It's unsustainable. This had to happen, and it's probably only going to get worse. So beware of where we're at. This is a Wile E. Coyote moment. Either we get that we're about to run off the cliff and refrain, sit in cash at the very least, short the rally at the very worst, or we could pretend that this bull market's never going to end, go buying the high beta stocks only to get walloped, because this is not going to get any better anytime soon, in my own personal opinion. Daily chart. So the daily chart, we have our double top, and today we broke to new lower lows, and we closed there. So what I predict is going to happen here is we'll probably rally tomorrow. We'll rally up to 219, thereabouts. It's probably going to be a ruthless rally to the upside. They're going to try to recapture this support level, and it's probably going to fail. And we have the Stokes on our side. Stokes trading down below 50, putting in lower highs. They're losing momentum. Traders are selling rallies, and that rally, it too, will probably get sold into. So I'm not going to be covering my short tomorrow. I'm probably going to be looking to add more if they rally it. Look at this volume today. This is not mom and pop selling 100 shares of the IWM. Those are institutions. The Tues, absolute and utter basket case. We have broken weekly trend, new sequentially lower lows on a weekly time frame on massive, massive down volume. Monthly chart. We are flirting with very critical support. Now, why do we choose the Tues to get short of? It's pretty simple. We knew they were extended, and we took a look, and I've spoken about it here at least a dozen times. And I stopped bringing up the chart because it was getting monotonous, but I'm going to do it now anyway. The top holding of the triple Qs is Microsoft. Microsoft, even after this recent sell-off, has quarterly RSI of 93.27. Think about it. Think about it. Microsoft, a $1 trillion company, has an RSI of 93.27. Gets better. Yearly time frame, RSI 94.01. This is a bubble. Apple, second largest position of the triple Qs. We are now negative on the year, but we still have RSI. This was above 90. We still have RSI at 87.26. So there's plenty of room to normalize on Apple. You want to put up a trend line here of where we might be heading? Let's use the closing price. I don't want to get this, we may need to use the lower price. We could, the lower extreme band here, we could retrace all the way back down to the 20 period and possibly on Apple to $90 a share. Here was Apple today. Lower highs, lower lows, rallies are getting sold. And, you know, the conversation came up earlier with a private member's live stream about, you know, is it time? The question came up, is it time to go adding to our short of the Tues, to our short of the small caps? And my answer was no, despite the damage that was done today, because the counter trend rallies are going to be ruthless. They're going to be rip your face off rallies. So you don't want to go shorting into a big sell-off. What you want to do is you want to wait. You want to take your crayon out, because the market has given us a roadmap. Because the path of least resistance has now changed from up to now down. This is now resistance. And note, every time we hit it, we sell off. So if we rally back, we should expect to see resistance here, sellers here. Then we could lean into the short side. What if we're wrong? Well, no big problem. We stop out if we manage to break out and above this upper band of resistance. Simple as that. That's why it pays to wait to hit that resistance level, because you know when you're wrong. And you're able to keep your losses very, very small, assuming you stick by a game plan. Now, these Stokes are very weak. I think we're going lower here on Apple. The banks. The banks have been on fire, but I've been warning, the reason why they've been on fire is that, yes, they were unloved, and they were cyclicals. They were becoming in favor. But the reason why they were becoming in favor is because yields were rising. And that while it's great, the banks will rally on rising interest rates, they will only do so if the overall stock market is rallying along with it. At some point in time, they're not going to rally on a consistent basis when you have the S&P 500 going one way and the banks aren't going to spend too much time alone going the opposite direction. Margin calls go out. Forced liquidation, it hits everything. So beware the banks. They're up on the week, certainly outperforming the market. Down today, but warning flag here. Let's take a look at some comments. Larry, hey brother. Sam, hello. Paul, how you doing, friend? Slav Zoot. When is the best to add a short position? I think I might have answered that question for you, Slav. If I didn't, let me know. Nestor, there is a gap in Apple down to 96.50. Let's go to the weekly chart. It's probably seen on a daily chart. $96.50. Oh, yeah, you're right. Yep. You are right, my friend. In that neighborhood. Yep. Very good point. What are biotechs doing this week? Oh, my God. Franklin. This is now down where below you sold. 40,000 Hedman. How you been, pal? M. McNeil. Hello. Anthony. Nah, I wouldn't forget. I had technical issues, and my phone was ringing off the hook, and I had to take the call. I've been waiting for this call all day long, so I had to take the call. So my apologies. Gianni, are we overreacting to the rise in interest rates? It's a function on the economy that should be priced in by now. No, I don't think that it's not priced in, because you need to think about it this way, is that there's been this assumption that the Federal Reserve was going to be able to manage rates and keep them low forever. The problem is this, is that, you bring up the Buffett indicator, you bring up the pillar sheet PE ratio. Frankly, I could just bring up a chart of here. Think about the damage that's been done of late. This is a chart of the number of stocks in red equals a PE ratio of 20 or greater, equaling overvalued. Obviously in line, that's the S&P 500, the line chart in black. We are still so far extended beyond a reasonable PE on the S&P 500, it's ridiculous. So we're expensive. So now the borrowing costs are going up. And it's especially going to hit the small caps the most, because they can't really go to market all that much. You have the larger caps are able to weather the storm far greater. They can go to the bond market. They can do other things to raise capital. But the small caps, that's why we're short of the small caps, because they're so overvalued and so technically overextended that they're just looking for a needle to hit the balloon. And rising yields is that needle. And you heard it today. The Federal Reserve, they're not prepared. They're losing the narrative. And I'll bring you back to last Tuesday, Wednesday. Fed Chair Powell in front of Congress, and he was saying, we're going to be dovish forever. So fairy dust and cotton candy for the rest of your life, don't worry about it. We're good. The Fed's got your back. What were interest rates doing while he was talking? They were skyrocketing. What were interest rates doing today while he was talking? They were skyrocketing. At some point in time, people are going to have to start to say, maybe there's a trend here. Maybe something's off. If a guy like me is picking it up and the news media is not talking about it, that's the news media's problem. They're not speaking their minds, man. There's a problem. So I think that they're losing control of the narrative. So stocks are technically overvalued. As interest rates rise, what happens? If their earnings aren't increasing, the stock becomes more expensive because their borrowing costs rise. So, and plus their input costs are rising as well due to inflation. Consumer discretionaries. I warned about this about 3 weeks ago. Beware. We were at the apex. This is a weekly chart, XLY, consumer discretionaries. I said, man, we're breaking one way or the other this coming week. And sure enough, hammered. Volume very heavy. Daily chart. I think that the discretionaries may pop here soon. We held 155 today. Watch 149.50 as support on the XLY. Energy. Still up on the week. Amazing. So, will this last? That's the question. And I was talking to fellow member Norris. I don't know if Norris is on. He likes Exxon, and he was asking me about resistance, about at around $65 a share. As a matter of fact, let's bring up XOM. And what I pointed out to him was this, is that, yeah, we do have resistance up in the 60s. The problem is that you have a 200 period moving average, which is still sloping down. It's going to act as a declining ceiling on Exxon. Now, it wouldn't be a big concern to me were it not for the overall market rolling over right now. So I would be wary here. Ultimately, it'll probably, if the market finds a footing and begins to rally, then ExxonMobil is going to rally. If it doesn't, ultimately, it's going to begin to roll over. And the shares of XOM closed pretty good today. Really good price action. What did the XLE do? Not horrible either. A little bit of topping action, but really good relative strength versus the S&P 500. Oil, this is the reason why you're seeing energy do well. Oil prices rising, energy rising. There's a very close correlation between XLE and oil. There's a 90% correlation between the two of them. So as goes oil, so goes the XLE. Gold. I have a price target on gold of $1,650. Right here. It's trying to hold 1,700. It's a hair's breadth away. I think that it's ultimately going to break. Daily chart. A lot of support back here. I'm actually second guessing myself right now. The market will tell us. The only reason why I'm second guessing myself is because the gold miners did very, very well today. I mean, you saw yields ripping higher. You saw the dollar ripping up higher. Gold closed, what, down 0.5% on the day? The gold miners closed down 0.5% on the day. And we bounced off the lower band of this weekly downtrend channel. I think that this is setting up for a bull case, to be honest with you. We're long of the GDXJ. I'm begging. I'm looking for ideally 42 on the GDXJ. Hopefully that holds. And then we're going to be loading up. And at some point in time, people are going to get the inflation is just ripping out of control. And the dollar's going to roll over. When that rolls over, gold, silver, miners. I'm not into buying physical gold because it's manipulated on the COMEX. So is silver. So I'd rather own the gold and silver miners. I do have a paper position in a leveraged ETF for silver. AMVA 007, thanks so much for explaining how to enter short after a rebound, touching the new resistance. You're welcome, my friend. Would it be better to short ARKK or XLK with a rising interest yield? I'm not familiar with, is that the ARK fund? It depends upon your risk tolerance. I'm not, I'll be honest with you. If this is Kathy Wood's, yeah, this is Kathy Wood's fund. It depends upon your risk tolerance, really. This is the first time I'm ever looking at this chart. ARK is down 9%. On the week, XLK. Yeah, so this really goes back. Oh, no, this is wrong. That's not XLK. XLK. Yeah, XLK is down 3%. So you have roughly 3 times the volatility on the ARK fund. So it all really depends upon your risk tolerance. And frankly, how well you're going to be able to do with abiding by your stop. So if you draw that upper band of resistance and you get short leaning into it, as the shares lean into it, if they break out, are you going to cover? because once that breaks out, ARK breaks out above that resistance level, it's highly volatile. So it'll rip your face off. Now, XLK will too, but you may have some jawbone left. Okay, so they'll both rip your face off, but ARK is really going to rip your face off. So if you're disciplined and you're going to stand by your stop and your game plan, I'd be fine with going with the ARK short. But if you're not, go with the XLK short. Less volatility, less risk, and you'll be less emotional if you have to stop out. Tell me what gold wants, what it really wants. That's outstanding. 40,000 Headman. Danny Brown, El Dorado is undervalued gold miner. FYI, thank you, sir. We're going to go to EDC in a second, Cena. I love EDC, not right here. I love emerging markets. When we come out of this, I'm going to be a heavy, heavy emerging market buyer. I've made no secret about that. We were along of emerging markets. We booked profits. We headed to the sidelines. Yes, we got out too early. I'll freely admit that. And you can help me forgive myself by smashing the like bucket. Blah. F that up. Nobody reminded me tonight to smash the like button. Did they? Oh, McCarty did. All right, McCarty, you got it. Sorry, man. I thought I was going to pull it off, and I stumbled over my words. Smash the like button, please. Thank you very much. And subscribe to the channel, please. NY Jets, Spice Girls was the best. What a group. Mad savages tonight. All right. All right, so GDXJ, we like it at 42. Gold money, we bought more yesterday. We bought back in yesterday. I still love this thing. Silver. Ugh, silver, problem here. Ooh, Ooh, bad. Silver. Silver's got to rally tomorrow. The reason why silver has to rally is because we had broken out on silver. Actually, this is an SILJ fund. These are the miners. We broke out back here the week of the 25th of January. We just had 2 minutes ago, alert just fired off on Thinkorswim that we were seeing some selling on the Tues after hours. Maybe it's a bad tick. I don't know. Oh, yeah. We closed at 304. Oh, we're down a couple of bucks. Not horrible. One of my alerts fired off. That's strange. Sorry about that. Okay. So we need to recapture 1450. If we don't, SILJ is in trouble. Regard to Anthony Salvio. Except for Bob Desmond, always bullish up. Man. All right, AGQ silver. Broke support. Lower highs, lower lows. Silver not looking good. I don't want to look at it. I own it. Uranium. Love uranium. Can't buy it right here, right now. We book profits on this back here. There'll be a time for these commodity trades, but just beware of the U.S. dollar. EDC. We're going to leave off with ADC. I want to go to some chart requests. Let's just bring it up here. Okay. So EDC is an emerging market leveraged ETF. If you don't want the risk and the volatility, go for the EEM. Now, here's the strategy. And I'm talking out several weeks to several months. At some point in time, people are going to wake up and they're going to realize the dollar is not worth the paper it's printed on. So what happens when you get the US dollar rolling over? Well, you have commodities ripping higher. And there's a school of thought that says that gold and interest rates can't rise in tandem. That is inaccurate. I will take you back to the 1970s. I'm going to go to EDC in a moment. I just want to prove a point. Okay, so oh, damn it. You're going to have to take my word for it. Back here, through the data doesn't go back that far to the 1970s. During this period here, in 1971, Nixon took us off the gold standard. That's when the dollar went like this and never stopped going down. And gold took off like a rocket. But as you got into 1976 through 1980, interest rates were rising along with gold prices. Why? It's because you had stagnant growth and inflation, stagflation. That was the last time we saw an environment where gold and yields can rise in tandem. Why does that happen? It's because inflation is outpacing where interest rates should actually be, the cost of money. There was too much money out. Cost of money was still too cheap. And it took them several years, Paul Volcker, to finally break the back. And mortgage rates went up to like 20% before they ultimately broke. Now you can get a 30-year mortgage for, what, 3.25% tops, whether you have a good credit score. So they can rally together. So at some point in time, you're going to get a correlation of yields and gold rising up together and the dollar rolling over, bonds, US dollar declining. In that environment, you don't want to be long of US equities. You want to be long of emerging markets, because when our dollar weakens, all their debt, emerging market debt, is priced in US dollars. So when the value of the dollar goes down and their exports, which are mainly commodities and also priced in dollars, go up higher, it's like a massive tax cut. And therein lies your trade. And that's going to last for years. And emerging markets priced relative to US equities are on sale. And they're going lower short term. So EDC nearing support. I think it's going to break support. We're going lower. And we will be buyers. At some point in time, we're just going to start dollar cost averaging in. But right now, take a look at this chart. We broke to new lower lows. We closed at a very trivial support level. I think we're going down here to bare minimum $85 a share, and we'll find a support level within this range. Also, what we like is Vietnam, but it too has finally begun to break down. We showed a lot of patience here, and it's now starting to pay off. I think we're going measurably lower. Let's get to some chart requests because I'm getting tired of hearing myself talk about what I want to talk about. Let's talk about what you want to talk about. Let's go to the members area. I first need to go over what members are looking for me to review. Then I'll take any super chats. And if we have time left over, then we will go to the audience. Now, I did a bunch this morning. I don't know if I got more this afternoon. Okay, what do we got? Nope. Nope. Nothing to go over. Same as this morning. All right. Pat, if you're on. Big Bear, if you're on. Anthony, if you're on. You have anything you want me to go over first? Nestor? Franklin is on. GM. Nestor with GM. Okay, let's do it. Again, folks, our sponsor, TrendSpider, 35% discount code below. Oh, I want to talk about PayPal. My alert went off on PayPal today. Right here. And we broke weekly support. This should have held. It didn't. One trading day left to go. Maybe we'll rally back. But I want to know if we do get a rally, is it time to buy? I don't want any sensitivity. This is one of my wish list stocks. I will be building a wish list stock list. I'll be sharing that with members probably this weekend. I'll be looking at only top tier high quality stocks. No junk, no Chinese SPAC names, none of that stuff. Only top tier high quality. And we'll be getting ready for a washout in this market because at some point in time we're going to be segueing out of our short positions, taking those monies and moving them into oversold high quality names. So PayPal, weak, not looking good here. We'll see whether or not it breaks down further or do we rally and recapture support tomorrow. GM. Not a bad week. Not bad at all. We're holding support. Is that an automated trend line? Yes. Here's the value of the automated trend lines. Click. It's holding the breakout on a monthly time frame. Let's overlay that monthly overlay onto a weekly chart. And there it is. I like it. I think this is a Bollinger Band squeeze play. Look at how tight these Bollinger Bands are. And, I mean, what were we down today? 1%? Not bad relative to the rest of the market. So, not horrible. Very light down volume. Take a look at this volume. There weren't a lot of institutions dumping today. I think it's a buy. Assuming that the market's not in free fall, I think it's a buy. Tight stop, though, just in case this market breaks. But I like it, Nestor. It's looking good. TLT. That's a good one. I skipped over it. Excuse me. I'm so sorry. I skipped over that. I wanted to go over it. I'm glad you brought it up because I already have it up. TLT. Quick story. I'm showing my humility right now. I bought call options here on the 24th. I think it was the 24th. 23rd or 24th, one of the two. And it rallied on the 25th. I got made nearly whole. And I said, you know what? I don't trust this rally. And I bailed out on it. I took a small loss. And the shares just kept ripping up higher. So I was right that they rolled over, but I could have waited to that final hour trade and booked a profit rather than taking a loss. But that's my quick story. Hope everybody didn't fall asleep on that. All right, so TLT is very, very oversold. I mean, RSI is at 26. It's a bond fund, for Christ's sakes. RSI at 26 is very, very oversold. We are at a support level. But frankly, we can head lower. So I'm not ready to go buying here. There is definitely good support where we are at current, but I really like 133.75. That is a very, very sexy support level to buy at. And don't forget, folks, remember tomorrow is non-farm payrolls, the pimp Mac daddy of them all in terms of economic data. Daily chart. Now, we could be putting in a higher low. That's the attitude we need to take. But weak stocks, weak bonds tend to get weaker until they don't. So we need to break out above this upper band of resistance before I would even consider opening a long trade. If it breaks to new lower lows, I'll wait for 133 to look to get long yet again. So I would be careful here. I would wait for a breakout. I would not chase any rally on anything right now. This market's on very, very thin ice. So be careful. So GM looking good. What else do we have? What time is it? I'm starting to pass out. 7:19. All right, we'll wrap it up with TMO. Oh, Thermo Fisher. We looked at this the other day. Yeah, bearish reversal bar. I mean, we broke support at 52.77. Sorry, 452.77. And support is at 437.12. That's probably going to get tested. Weekly chart. If it breaks the support level, it becomes a short. So I'm going to set up an alert for a bounce, touch, maybe get long. But if it breaks, it becomes a short. Daily chart. That's exactly where it's going. It's coming down here. So I would beware and note, again, the value of the automated trend lines, man. I'm going to take them off. Note where we rallied up and into today and failed. Resistance. All right. And with that, folks, I'm going to bid everyone a great night. Thanks for joining in. I apologize for being late. Thanks for bearing with me. Great group. Everybody have a profitable trading day tomorrow. Remember, today's lows could be tomorrow highs. Don't chase the morning rallies. It's exactly what they want you to do. The institutions, they're going to want to rotate out on rising yields. So don't become their plankton. Be the whale, be the shark, and avoid those guys. Wait for the final hour of trade. That's one of my rules. Wait for the final hour of trade before executing a trade. If you can wait for the last 5 minutes, all the better. Make sure that rally lasts throughout the day and that you're not buying that rally only to see it fade by 3 p.m., 4 p.m. in the afternoon, okay? That's what happens in this kind of environment. Don't get lured in. Have a great night. Be well.